Okay, we're going to spend some time, and we're going to be able to zoom a lot quicker through it, but we're going to zoom through those last three categories of AJEs, okay? And some of these we've really already kind of discussed or thought about before. Let's talk about unearned revenues, okay? Going to the computer here. Unearned revenues are a liability, right? If customers pay us before we provide the product or service, that is not revenue. That is unearned revenue. It is a liability because we either owe them their money back or we owe them the service. So let's look through an example. I don't think this one's going to be too tough. On October 1, 2013, Ox University sold 1,000 season tickets to its 20 home basketball games for $100 each. So they made the following entry. Now, this is not an AJE. We know that because there's cash involved and because it's on October 1st, okay? But they sold 1,000 of these at $100 each. 1,000 times 100 is 100,000. But that is unearned revenue. That is a liability. Why? What have we not yet provided? The basketball games, right? Okay? Well, at the end of the year, Ox University has played 8 of its 20 regular home games. They've played 8 of 20. Another way of thinking that is what's 8 divided by 20? 40%, right? They have played 40% of their games. So they've earned 40% of that 100,000. So they can decrease unearned revenue by 40,000. Okay? Their liability was currently on the books at 100, but we have earned 40,000 of it. So now what do we owe? Our liability is now at 60,000, right? And we can match that revenue or book that revenue in the proper year, correct? If we didn't do that AJE right there that you're looking at, our liabilities would be overstated and our revenues would be understated. Do you see that? So that is an example of an unearned revenue AJE, okay? All right, let's talk about the next category, accrued expenses. Now, these last two categories are when the cash flow actually occurs after the expense and revenue are recognized. Really the best way to do this is look at an example. But these are costs incurred in a period, but we haven't yet paid for them. So look at this situation. Barton Inc. pays its employees every Friday. Now, year-end, 12/31/13, falls on a Wednesday. Now, as of that Wednesday, 12/31/13, the employees have earned salaries of $47,250. Okay, they've earned that. So they've worked that. We owe it for Monday, Tuesday, and Wednesday. Now, we're not going to pay them until Friday. But do you see where we have to show that liability at 12/31? We have to record that. This is always a very important adjusting journal entry when I go do consulting, okay? All right, so what do? You book this journal entry right here. You debit salaries expense for $47,250 to match that expense to the proper year of 2013, and you record the liability of $47,250. That puts that liability on the book. If you didn't make this entry, your liabilities would be understated. And your net income would be overstated because your expenses are understated. I mean, think about right now. As we speak right now, Sprint, how much accrued salaries do they have? They have millions, don't they? This is an important liability that I always make sure is recorded on the books. Because those people have earned that money, right? Even if we shut the doors, we owe them that money. So you got to get that liability on the book. Sometimes you will see this category in regards not only to salaries or wages, but in regards to interest. Maybe at the end of the year you owe $800 worth of interest. You don't have to pay it that day. These folks are not getting paid early. But you have to record the expense and the liability. And we do that with an AJE. Does that make sense? Hope you're reading your textbook too. Okay, the last category is accrued revenues. These are revenues that we've earned, but we've not yet received the cash. The cash comes after. Let's take a look at an example. Let's say we're Smith & Jones CPA, and we had 31,200 of work completed at December 31, 2013. Let's look at the computer here. We have 31,200 of work completed at the end of the year, but not only have we not received the cash, we haven't even billed them. But let's make the AJE necessary to record that company's earned revenue. Do you see where we need to book that as revenue? And we need to show an asset. They owe us this money, right? This is revenue we can book. They haven't paid us, but we've provided the service. Revenue recognition principle says we can recognize this revenue. Does that make sense? So we have to book this entry right here. Okay? I don't know if it gives us a T. No. Now, staying on this computer, this category also might be used for interest that we've earned at year end. We're not going to get paid the cash yet, but maybe we have an investment and we've earned some interest. We have to show the interest revenue that's earned, and then we would say like interest receivable. Okay? It doesn't change the cash flow, but we have to show the asset and the revenue on the books, or we're not properly reflecting reality to the readers of our financial statements. Does that make sense? Okay. See, we got through those last ones a lot quicker, didn't we?